So we're delighted to welcome Greg Magadini. He's a pioneer in many aspects of decentralized finance, not only in crypto options, but across that entire space, I think. And he's got a great service that I think anyone can subscribe to at various levels, some free, one free level. And for those, quite a few of us are interested in crypto already, and certainly a large number of us are interested in trade options already, mainly in stocks so far. And so I think this will be a horizon broadening experience for all of us, one way or another. And I will hand it over to Greg.
Cool, thanks, Don. Thanks so much, everyone. Happy to be here. Just kind of a quick, brief background. So my background is as a trader. I was a proprietary trader. I got started at S&P Capital in New York, and then Chopper Trading in Chicago, and then DRW in Chicago. And then in late 2015, I left DRW to trade my own book in the crypto space. And I've been doing that ever since. And then in late 2019, me and my co-founder decided to build a crypto options analytics platform, because my first love is options and my second love is crypto. And it seemed like a lot of this stuff I was building in VBA, and it seemed like there was a good business opportunity to launch an analytics platform as well. So I'll just kind of give you a brief overview of the crypto option space and then how I think about vol trades in the space. So kind of getting started with, what does the crypto option space look like right now? Most of it is concentrated overseas. So Deribit is the main exchange. If I look at sort of the cumulative open interest over time, we can see that Deribit is a huge fraction of the market. You're looking at 95% of Bitcoin options open interest. And then if you look at volume, we have about 5 exchanges here: Deribit, Bit.com, which is in Asia, OKEX, which is also in Asia, LedgerX, which is here in the US, and then Delta Exchange, which is in India. So if I just get rid of Deribit and Delta, we see that Bit.com, OKEX, and LedgerX are all about equal. So LedgerX provides 1/100th multiplier for Bitcoin options and 1/10th multiplier for Ethereum options. Everything is physically settled. So you have to exercise before expiration if you want to take delivery, and you have to pony up the strike price value or else sell the option before the end of the day. Something that's really interesting is looking at the put call ratio from the different exchanges. So LedgerX here is in blue, and it's about a 0.1 put call ratio. So that means there's about 10 times as many calls of open interest as there are puts of open interest. And that really kind of shows sort of the appetite for this product here in the US. People are really just buying upside vol on the options in order to get exposure on prices going up. In Deribit, we see like a slight 2-to-1 ratio, twice as many calls versus puts. And then in this exchange over here, Bit.com, Bit.com is a mining company that launched an options exchange. So a lot of crypto miners use this option market to hedge their future mining rewards and to ensure that they can sell at the put strike price. And then OKEX is kind of sort of in between. So again, Deribit is the main exchange. We look at everything Deribit as far as how pricing goes. So I'm going to just jump into the volatility surface and that type of stuff. So if I go to my platform here and I click current order book, so there's a few things to look at. The first thing that jumps out here is this chart on the right. This is going to show me the relationship between realized vol and implied vol. And I can look at this for different tenors. So right now, the 7-day, there's a lot of variation in 7-day vol, both from realized and implied. 30 days typically what people look at. And if I compare the two, we see right now that Bitcoin vol is trading around 55, but we're realizing about 45. And so right now there's kind of this big premium in the vol space, just from a relative perspective. And the way I think about that is that right now there's a lot of uncertainty in the markets. We see the VIX is pretty high. We see oil vol is super high. Natural gas vol is super high. And then the correlation between Bitcoin and the NASDAQ has been strong lately. So people are hedging their crypto book and they're willing to pay a premium for that. So another way to look at sort of how people are hedging their book, these are the skews. Let me just skip that real quick and jump all the way down to the skews over time. So when I'm looking at the skew, what I'm typically looking at here is going to be the 25 delta, 35 delta, 15 delta, and 5 delta. So I like the 25 delta the best. That's kind of, it's out far enough in the wing, but still has enough meat to the options to really have sort of an impact. And if I look at the historical relationship, oops, put it on the wrong date here, let me try it again. If I look at the historical relationship, so now I'm looking at a 1 year skew. Actually, let me go back 2 years. This is really interesting because we had the pandemic. So we can see how the pandemic affected the Bitcoin vol surface. So something that I think is really interesting is contextualizing the extremes of the vol surface. And so when we see, give us a second to load up. So let me kill the 7-day vol real quick because it's very bouncy. So if I'm looking at 30, call it 30, 90, and 180. What we can see here is that in the March of 2020, when we kind of had the massive sell-off in all risk assets, including crypto, we had this skew, which the way that we measure it is we look at the 25 delta call vol minus the 25 delta put vol, and we can see that the put was trading 20 points above the 25 delta call. And so that kind of panic move brought us down all the way to -20. Then in sort of a recovery market, we can see that skews typically in the crypto space, this is very different from equities, have a premium to the call side. So in normal markets, we're looking at between 0 and 10 premium to the call side. And then in May of 2021, so exactly about a year ago, we had a huge sell-off in crypto again. And that basically sent the skew negative again, recovered, and now we're kind of back to this no man's land, so to speak, sort of like the median of all that stuff. If I look at the 180 days, this is something that's pretty interesting. The 180-day skew is rarely negative. So when I think about vol trades, I'm looking at what part of the vol surface is different than what it's been in the past. So here we can see that in the crisis of the pandemic, we see -3 vol in this big sell-off in May of last year, and I'll show you what that sell-off looks like in a second. We see that went about -7 points, and now we're hanging out in the -3 zone. So something to keep in mind is that calls are puts and puts are calls, meaning you can always synthetically build a put or always synthetically build a call by shorting the underlying versus the put, or so on and so forth. So basically here, what I'm thinking is, right now the skew is very negative, but this long dated skew has rarely been this negative. So if I want to get short the market, I can actually buy these calls and short the futures against it. And now I'm kind of buying this cheap side of the surface while still having a delta neutral bias. And that way it's kind of financing this vol premium that we're seeing. So if I look at 180 days out here, this is actually not bad. So we're kind of hanging around. RV and IV are about the same, but the shorter distance is RV is a little lackluster. So if I can buy the skew cheap and then synthetically build some sort of strangle, that's a pretty nice way to get long vol. So that's kind of how my thinking is. So what I like to look at as well is the underlying markets. So all these options are future options. And so what happens here is that the futures basis will move around a lot as well. So let me just highlight this 90-day basis. So basically, here's the sell-off that we saw in May of last year. Let me just highlight the price chart, we saw prices go from about 60,000 down to 30,000 in a couple weeks. So it's a huge 50% move. That's why that vol surface moved so much on those last slides that I was pointing out. And if I look at the basis, and the basis is really the Bitcoin cash market versus the futures price. And so I can see that the basis here pretty much has had a high of like 41% annualized premium, or in times of panic, it's been as low as, call it the zero line. And then in the pandemic, we actually saw it negative, briefly negative 44%. So the idea here is that, and again, to me, this is very different from equities. In the equity space, when markets are crashing, the risk-free rate is moving a little bit, treasuries move a little bit, yields go down as the market crashes, but not by a large magnitude. In crypto land, people will buy up the basis because they want to get leveraged long. And so they'll actually shoot up the futures price along with the actual spot price. And so what happens is that you have a positive correlation between prices and the basis. And it's kind of like your risk-free interest rate that plugs into your option models is actually a big component in the crypto space because it's not stable. It swings around a lot. And so when I go back to my trade thinking, when I'm combining the vol surface, and I was looking at that 180-day, pull that up again, that 180-day skew, I can see, okay, cool. If I'm buying this skew at a discount on the vol and I'm shorting the futures against it and the market crashes, I should actually make some money on that basis, compressing even further. Or if I'm wrong, the basis will go against me, but then the skew should flip around and become positive again, meaning the call is going to outpace the vol gains versus an equidistant put. So that's kind of a way that I like to think about sort of this type of trade. I'm happy to maybe pause it right there. I know that was a lot of information, and kind of just answer some questions or kind of hear anyone out if there's anything that was unclear.
I have one quick question, Greg.
Yes.
If I may, you mentioned the basis trading here, where we're trading the futures against the cash as well as the option pricing. And you would some of the distortion from efficiency, if we can say that, be already priced into the options, or is it usually not?
So the current basis will be priced into the options, but I don't think people are modeling, and it's a kind of a tough call. I think it's still inefficient right now. I don't think people are really modeling the correlation component of the basis and the option. So if you look at the term structure, let me look at a historical term structure where the volatility is pretty high. In high vol markets, as you guys all know, we have backwardated term structures. And then in crypto, what happens is that even in high vol surfaces, even in high vol environments, the term structure, the back end still is elevated, and it's harder for it to go backwardated. And part of that is people are willing to pay a premium for that back end, knowing that the back end is going to move around with the basis. But that being said, I think it's one of those phenomenons that is not very well understood, at least not at this point in the crypto space, that I think provides a lot of the edge. So to answer your question, some people know about it and it's priced in a little bit, but I do think there's still edge to be had right now with sort of that insight. So here's a good example of what I'm talking about. So if I go back to May 14th of last year, when we had that big crash, vol's a lot higher then than it is now. We can see on this right-hand chart. we can see that the term structure is still pretty flat, for the exception of the front end. And so people are still willing to like bid up the back end of the vol surface.
Fantastic.
Does anyone else have any questions? Okay, cool.
How much capital is required to get into a trade like this?
So the crypto option space is actually really capital efficient, in a like dangerous way in a lot of ways. So right now, futures require a 1% collateralization rate. And then the option market is pretty similar to traditional finance. So that's like 20% of the underlying for a short option. So if you're putting like call it a 1-by-1, for example, like long one call and short the future, you're pretty much looking at about 20% of, excuse me, if you're long to call and short the future, it's almost nothing. And if you're short to call and long the future against it, then it's about 20% of the underlying.
Perfect, thank you.
Yeah, totally. So another tool that I think is really interesting is the volatility cone. So pretty much I can pick out any date range. Let's just say I want to look at the past 2 years. So I can stick that in here. And what this is going to tell me, it's going to show me the realized volatility of, in this case, Bitcoin for all these different measurement windows. So I'm looking at 1 day, 7 day, 14 day, 30, so on and so forth. And I can see in the past 2 years, what has been the maximum realized vol for these measurement windows, what has been the minimum here in pink, what the median is here in white, the upper and lower 25th, 75th and 25th percentiles, and then where realized vol currently resides here in blue. So we can see here that given the past 2 years, and that includes doesn't include the spike of the pandemic, but it includes the second half of the pandemic, and as well as that sell-off we had last year. Right now, vol is currently on the lower 25th percentile. So typically, basically, Bitcoin volatility is looking at around 68. Looking at 30 days out, we've seen it as high as 150 and as low as 25. So we're kind of in this lower end of the realized vol space, which makes a lot of sense with that relationship between realized and implied. So one of the things about volatility trading is that volatility is mean reverting, and the obvious trade is usually expensive. So betting that vol is going to mean revert to the median, for example, a lot of that will be priced in right away in the IV market. And so you're kind of already buying IV quite a few points higher than where realized is. And so just like options, like the easy trade is has a high carry cost to it. And so the mean reversion trade and just pure vol has that same component to it. We have another thing here called the devol index. So this is pretty much your VIX. This is going to be your VIX of Bitcoin options. And I can go back here and check out, call it the past year. So this is going to be this 30-day constant maturity, incorporating the whole strike surface for Bitcoin options. And I can see how this thing has been moving in the past. Something else that we have here is we have kind of a chart showing spot versus this vol index. So I can look at the past 6 months and basically see, okay, what is kind of visually eyeballing it? What is the relationship between spot prices and volatility? And then here we have a vol of vol, which we're basically taking realized of the index. And this gives us a really good idea of how jumpy is this index. So right now, the vol of vol is around 80. We've seen as high as 120. This is really similar. What we're doing is realized, but if you think of VVIX, that's going to be your implied index of VIX options. And so it gives you a good idea of like how stable is vol here. And so right now, 80 is not too crazy. Vol can seem pretty stubborn. And in here we have a variance premium. And so basically what we do here is we shift over realized back, and we compare that to how implied was priced. So implied is, this index is 30-day implied vol. So it's pricing how the next 30 days of realized are going to look like, and what has this relationship look like when we shift it. Well, now that we know how the past played out, let's see what that relationship was. And then here we basically have a chart showing the implied versus realized variance premium or discount. And this again gives you a really good idea of, how by how many points can vol be overpriced. So it can be as high as 30 points overpriced. And the way you translate that into dollar terms is you just take the vega times 39 points for a 30-day option. And that tells you how much dollar wise any option is over or underpriced should this relationship continue. Happy to answer any more questions if anyone has questions. Okay, cool. Just looking at LedgerX, because this is a market that we can trade, we can look at sort of the distribution of where people are placing their bets. So if I look at kind of contracts in existence, I can basically see, calls, most of the open interests are on the call side. I can see that people are trading really the 75 to 400K range. So that gives you a really good idea of like how people are placing their bets. And then we have this other chart, which is like the yield chart. So what we look at is what's the yield of a covered call. Let's say we analyzed it, and we can kind of get a good graphical, estimate of, okay, if I sold covered call at 50,000, I'm looking at a 17% annualized yield on my money. So this is like a really good way to kind of quickly understand what these kind of basic strategies are pricing out. Something else that I like a lot is looking at how retail is positioned in these markets. So if I look at the option scanner, I can basically see kind of up here, quickly look at which options are most popular, which ones are trading the most. So if I look at basically the past 7 days, I can see, okay, this $37,000 put has gained a lot of open interest for May 6th. And then if I look at, call it the past month, which option has been the most popular. So we're looking at this, well, this one just expired, but we're looking at this $48,000 call that expires at the end of May. So let me just go ahead and look at that expiration, and I can kind of sort everything. So I'm sorting everything by OI right now. I want to look at the call side. Check this out. So let's see. Let's look at a $60,000 call that expires May 27th. So if I click that, the first thing I'll see here is we tag a direction. So basically what we're looking at is who's the aggressor on the trade, who paid the spread. And so if the option buyer paid the spread, we call that a buy, assuming that the market maker is on the other side. And if the aggressor paid the spread and hit the bid, then we call that a sell, assuming the market maker is on the other side. So we're looking at all non-block trades and tallying up all the aggressors for this particular expiration cycle, this May 27th expiration cycle. And it gives us a really good idea of what we call retail or non-block traders are doing. So we can see, okay, buying $44,000 calls, $48,000 calls, $50,000 calls for the end of May. That's kind of really popular. And then selling out sort of this tail risk is somewhat popular as well. Selling $20,000 puts, selling $34,000 puts, and selling $38,000 puts. Obviously, there's some buys on these other strikes as well. So overall, it's kind of balanced. Here, I can just look at a date range and look at what's been the activity since, call it, the 27th to the 3rd. What's sort of the net tallies? Okay, well, the past few days, people have been buying back these tails. Here, I can look at the actual price of the option itself. So it was this option that I clicked down over here, $60,000 call. I can see how that's been moving. And then here I can look at how the open interest has changed versus the non-block volume. Right below it, I can see the block volume for it. And then below it, I can see a histogram of the traded implied vols, and then kind of the net positioning in this contract. So net aggressors since inception is pretty much flat, and in the past few days been buying back a lot of these calls. So I really like this to help me figure out who's on the other side of my trades, how is the market really positioned, and we just assume that non-aggressors are the market makers. Happy to answer any questions if anyone has questions.
That's a fantastic definition of who is the aggressor, who's the market maker. Is that done also? I'm just curious, also for equity options?
Yeah, actually, there's some people, there's some services that do that. I think maybe Spot Gamma is one of them.
Oh, okay.
But yeah, people will look at basically who pays the spread, how does the order book change pre and post trade, and really tease out buyers and sellers. And I think it's pretty safe assumption to just assume that market makers are on the other side of those trades, assuming open interest changes and stuff like that.
Thanks. Thanks very much.
Yeah, totally. Something else that we like to look at is the block trades themselves. So let me go ahead and pick out a date range that makes sense here. So April 28th to today. Here I can go ahead and look at where have block trades been going through. So Paradigm is this RFQ, which means request for quote service. Here in the crypto space, what people will do is that they'll say, hey, I want to trade a butterfly and I don't want to pay crazy spreads by just paying through the screens on Deribit. Send me a quote. So there's about 400 traders on Paradigm. About half of them are market makers. And the person who says, I want to trade a butterfly will say, I want to trade these strikes, this expiration, blah, blah, blah. And then market makers will come back with a two-way market. So the market maker doesn't know if the customer wants to buy it or sell it. And so they'll provide two-way quotes, and then the customer will buy it or sell the quote of interest. So if I look at these block trades, and block trades are about 30% of the volume, I can see where people are placing their bets. So we call this the block sniffer. Puts are on the negative of the axis and calls are positive. And I can see, okay, most of the action is in this $40,000 strike. And then you can look at all the expirations. You can turn some off, look at the ones of interest, so on and so forth. Look at the distribution of puts versus calls. Here I can see the breakdown of strategies. So I can see kind of all the block trades. Most of them are simple calls. Then we have some simple puts, straddles, strangles, diagonals, call spreads, call butterflies, stuff like that. Here I can see what day of the week, when this particular past week has been the most popular. So Friday has been the most active for block trades, and then 1 a.m. UTC has been the most active hour of the day. And here, what I'm looking at is this is going to be the constant maturity term structure. So I'm looking at 7-day, 30-day, 60-day, 90-day, 180-day at the money vol. This is a 1-minute chart. So I can see throughout the day today how the vol surface has changed. So we see a spike in the front end. We're starting to see a little bit of the front end go backward while the rest of the surface is in contango. And then if I hover over these green lines, each one of these green lines is a block trade. So I can hover over these green lines and see what exactly was blocked here. And so this is kind of a cool feature to see what bigger players are doing. And then same thing here, but instead of the term structure, it's going to be the skews. So we can see, the 7-day skew is going down a lot. This is this pink one. So as skew goes down and implied vol goes up, we know that people are buying puts, and it's changing the shape of the volatility surface. And in here, I have a table that can just break out all the individual trades. So we have block IDs here, so and then count. So count tells us how many legs are part of this block trade. So we're looking at this block ID 37,958, and I can see, okay, someone traded basically $34,000 puts versus 25 $44,000 calls. So we're looking at a strangle, and they sold the strangle at basically, call it 60 vol average. And they got paid 31 grand in premium. And each option was, on the put side was worth 853, on the call side was worth 423, so on and so forth. So it really gives you a good idea of like individual trades, kind of really digging into it. Again, same trade here for 125. Here we have another one. We have a call spread, 42 by $46,000 call spread. And then here, if we scroll down a little bit below, these are the outright block trades that only have a simple contract. So here someone just bought 25 $37,000 puts, paid 70 vol, so on and so forth. So this is a really good idea, or a really good tool to sniff out what the bigger players are doing versus the option scanner tool sniffs out what the smaller players are doing. So really good tools to go alongside each other. Happy to answer any questions up to this point. Cool. All right, and then there's a couple new things that are out in the decentralized finance space. So what we have here are simple option vaults. So the way that option vaults work is that they're just covered call or cash secured put selling strategies. So people will lock up, call it their Ethereum or their Bitcoin, in a contract address, a smart contract address, and then that protocol, which is the people running the vault, will basically sell covered calls against it. So we have a bunch of different protocols in the market. The biggest one is Ribbon Finance. And basically, if you click here, you can see Ribbon Finance. I can order it by notional sold, basically ETH $25,000, $2,500 puts. They were selling the 1 deltas for 48 vol. Here's another one, ETH selling the $3,200 calls. And these are all weeklies. So very short dated, far out of the money, looking at 5 to 8 delta. So people hope to not get exercised, but they just want to earn a little bit of yield on their holdings. And you can see like the absolute return here. It's pretty small, but it's a weekly return. And so the annualized percentage yield is around 16%, so on and so forth. So people really like that. It's a huge source of volume right now. And so it's just something that we think is interesting to look at. There's still about $500 million worth of notional in these products. And then we have some more products that are in the DeFi space. We have this thing called Squeeze, which is basically like a perpetual straddle that people can buy or sell. We can look at the vol here. This thing goes between 74 and 90. And all these products are completely collateralized and traded on chain. And then FTX, which is a big exchange like that now just bought like the Miami arena, is they launched something called move contracts, which are tokenized straddles. And so if I look here and I want to look at call it the quarterly move contract that expires at the end of June, I can see, okay, the strike price on this thing is 44, call it 44,000. And then we can see right now the way that it's priced at 56 implied vol, which is pretty in line with their bit. And then you're looking at negative 46 delta because it's already way in the money. Spot prices are at 37,000, 37,800. This straddle is at 44,000. And then you can see kind of the vega is at 92, the theta is at 51. And if I scroll down a little bit, I can see how this IV has been moving throughout the day. So a low of 56, a high of 59. Excuse me. We've been picking up negative deltas as the prices of Bitcoin have been going down today. We can see the gamma is pretty flat because it's pretty small. We can see theta pretty much throughout the day as implied has moved and stuff like that. And then lastly, we can see how the vega has been moving as well. So this is kind of another more exotic option tool that's been gaining a lot of popularity. So we kind of built out the Greeks around it to allow people who are trading that stuff to kind of normalize it back to traditional terms. Cool. And I think that's pretty much the gist of it. This is kind of how I think about stuff, but I'm happy to answer any questions.
Let me ask one, if I may. You mentioned that gamma was looking low in that particular moment. How would one interpret that?
Well, it's just because you know how gamma is a price per dollar, and then because Bitcoin's like a $37,000 instrument, each gamma per point is so squished that on a chart it's like 0.00008. So it ends up being like pretty flat. If we had let me look at Squeeth, for example. Squeeth is a tool built on Ethereum. You can see that the gamma moves a lot more there, just because 1 point in Ethereum is about a tenth of the size.
Huh.
But that's just kind of a quoting convention. It doesn't really mean anything much beyond like we should probably quote it like per 1,000 points or something like that instead of per dollar.
How would the liquidity of these sort of special instruments or pools, or however you want to call them, these special traded instruments or wallets, I guess, are they liquid enough in general?
Yeah, so Squeeth is very illiquid. That's probably $1 million a day traded. But these move contracts, they trade a lot. So I mean, this is like 283 of these traded. So you could think of it as 283 straddles. Each straddle has about 40 grand of notional. So it's a decent amount.
We have RFQs, request for quotation on the CME, but generally I seem to find them lacking in the equity option space. Are they really there, but just not visible at the retail level?
You mean in the crypto space or in the equity space?
Well, you showed that they're in the crypto space, which is great. Is it the case that the crypto space is actually easier to find these kind of instruments than in the equity space?
Yeah, I think in the crypto space, the minimums are a lot lower. So for an RFQ quote in crypto, so you can see here, this is like the volume. Let me just look at the contracts per day. So in blue, this is the amount that are block traded. So you can see that the block trades are a huge percentage of the daily volume. And then as far as the minimum size goes, for Bitcoin, it's 25 contracts, but you can split it out between legs. So if you're doing like 12.5 by 12.5 call spread, that counts. And if you're doing a tight enough call spread, that's actually not that much size.
Wow. Who else has some questions for Greg?
You mentioned a lot of different trades. Can you briefly review those that you talked about at the beginning? And if you have any other trade ideas, we'd love to hear them.
Yeah, sure. So I think the main one for me right now is looking at sort of the short term / call it medium term, 30 days relationship between realized and implied. Right now, it's hard not to want to buy vol because of everything that's going on, and the rest of typically vol is very correlated between asset classes. So the rest of the asset classes are in a higher vol regime, and crypto is in a very low vol regime. So there's a divergence there that's interesting. And so we can kind of see that here. And then my thinking is, well, how do I buy this vol without getting completely overpriced by things that are priced in right now? So, oops, that was the wrong chart. So the way that I would do it is I would look at the part of the surface that is historically underpriced, and it's offering me a cheap way to buy long vol. So what I would do here is I would buy the $180 expiration call, and I would probably do around the 25 delta. And then I would short the futures against it to be delta hedge. and now I'm long vol, but in a part of the surface that's relatively cheap. Here's the term structure over time. You can sort of see, just get rid of the noisy ones. You can sort of see that, in the past year, vol's the lowest it's been in the past year, while the VIX is a lot higher than it has been about a year ago. So to me, that divergence becomes interesting.
Fantastic. And you do that in a 1-to-1 ratio between the call and the future?
So you would do basically one call and a quarter contract short, or quarter Bitcoin. So I would do a 1-to-1 delta hedge.
Gotcha.
Yep.
So what are the multipliers for those?
Yeah, so it's all a one multiplier for Deribit, and then if you look at Ledger X, it's going to be 100-to-1. Excuse me, you need 100 contracts for one Bitcoin on Ledger X.
Okay, and then but you just do a quarter of the future.
Yeah, exactly. So I'm just thinking in Deribit terms. If I buy one call, I sell a quarter future against my long 25 delta call.
Gotcha. Okay. Are there any other trade ideas or things you've had success with in the past? Like if we had a regime change of some sorts, what would you do?
Yeah, so to me, the other one it's part of that same trade, but the other component is really the basis of it. Those are the two that I think complement each other right now that I have any sort of conviction on. It's getting this call relatively cheap, historically speaking, and then selling the future, which has some basis implied in it. And then if we go down, if the market crashes, not only do I think vol goes up, but I think the basis right now it's about 3%. I think it at least goes par, if not negative. So I'm going to make money on higher vol as well as extended basis compression. And then if it goes the other way, if crypto rallies, then I expect the call skew to increase. Obviously, the basis will probably go against me as well, but it'll be hedged out by that call skew. So as long as we have an actual bullish regime where we're starting to go back to highs of last year, then I'm going to make money on this position to the upside. If we have sort of a slow grind up, then that's not going to be, that's my worst case scenario.
Okay, so that's worst case. So do you have any sort of market bias or outlook currently?
My bias right now is that vol is cheap compared to traditional finance. So my bias is like find ways to get long vol in crypto that are not fully priced in yet.
Perfect. And then how about directionally? Do you have a biased where the market is headed in the next 6 months?
Not really. I think so. Here's how I think about it. The exposure that I want is I definitely want some upside tail exposure. So like I do think there's a potential for some like G20 central bank to say like, okay, we're just going to allocate, $500 billion to Bitcoin, and then the price just goes crazy. Like it could go to like 80,000, 100,000 pretty quick. I kind of always want to have some sort of exposure to that. But as far as tail scenario aside, I'm sort of leaning that risk assets are going lower right now. Interest rates are taking everything, repricing everything lower, and crypto, all else held equal, will also reprice lower. So I think in the short to medium term, I'm pretty bearish, but there's kind of this tail, anything can happen that I want to have exposure to. So financing long tail, long upside tail, and then holding sort of a core short bias on crypto for the time being.
That's great. And what did you by chance hear about Fidelity's announcement this week about how they've basically built out their backend platform to support cryptocurrencies in 401ks?
I actually did hear about the 401ks. Yeah, that's I don't know. To me, that's pretty bullish for sure. But I don't know if that is going to translate necessarily into short term to medium term. I think if everything's selling, everything's going to sell.
Yeah, I think there's caps on it currently. I think it's only like 20% of your allocation. And then right now it's just one company kind of as a beta or preview. And it's up to various corporations to enable that for their employees.
Yeah, that's interesting.
I guess retail traders, so-called, and I'm not sure we should use that term at all. I don't like it, but what people call retail traders are generally viewed as extremely naive in terms of their approach to trading. Does that also hold true for crypto assets, or not so much?
I would say crypto is mostly retail. So for the exception of things that are exclusively blocked, I just kind of, and market makers, I just assume everyone's retail. But I do think crypto has this FOMO tendency. So people want to get long crypto when crypto is going up. And when crypto is going down, it's almost like no one really cares about it. And so you have this volatility dynamic that as crypto is going up, things become more and more volatile. And we've really saw that in like 2017 compared to 2018. So 2017 was a big bullish up movement, and 2018 was a bearish movement. And so 2018 kind of floated lower, and then 2017 kind of exploded higher. And so to me, that relationship still exists, and you really see that in the basis. You see that in the vol as well. So late 2020 to early 2021, we saw a big move higher in crypto prices. So that's when over summer 2020, Bitcoin was about 10,000. And by April 2021, it was 60,000. So it was really bullish. And you kind of see here in the vol space, look how like in January of 2021, like the vol just kind of went crazy. And so, and this spike is real. And so pretty much people get kind of this fear of missing out, and they're willing to just kind of pay anything to either get leveraged long exposure in the futures or get some call options, and the vol kind of goes crazy. Let me just show you the actual like spot prices, what those did. So you can sort of see this is summer. This is summer of 2020. And then by January, we went from 10,000 to 40,000. And that's where we saw that huge vol spike. And the vol high was here at 40,000. And then vol kind of came back to earth pretty quickly. And then prices actually continued higher to 60,000. And if you look at the basis, I mean, the basis is a pretty low risk trade. You're just buying cash, selling the future against it. I mean, that was paying 48% per year of return for no delta risk and only exchange counterparty risk.
If I could ask, if people, and you covered this already to some extent, but if people want to get into trading crypto options, obviously your service would be, and you have a free version of it as a starting point, I
Yeah,
know.
Totally.
Would be a great starting point. But, and you have some videos too, explaining some of the concept on your YouTube channel.
Yep.
Which is gvol.io, I think.
Yep.
But generally speaking, how do people gain some sophistication in trading either crypto options, or for that matter, any options?
Yeah, well, I think one of my favorite things about finance is that there's a lot of really good books written. So one of the books that I like a lot is Volatility Trading by Yuan Sinclair.
Yeah,
that's a really good book. So that's probably my favorite book. That's what I would recommend. And then the Natenberg book is kind of the classic as well. Option Pricing and Volatility by Natenberg.
absolutely. We got some questions from some other people.
We also have a weekly newsletter. Let me just, where we kind of recap everything that happened in the vol space. Let me just share that here in case anyone's interested in it. I'll drop it in the chat. And as you mentioned, Don, we do have a free version of our platform, and that's at gball.io. Are there any major brokerages that offer options on crypto? So basically, we just had CME micro futures launched options against. Excuse me, CME micro futures just launched options. So that's pretty interesting. That's a nice way to trade options in the traditional finance space. And then BITO also has options against it. So BITO is a futures-based ETF, BITO. Obviously, with the futures-based products, you're paying this basis, and typically the front end of the futures curve is the most expensive. So there's a little bit of a drift downward from that basis cost, as well as rolling fees and stuff like that. But it is a pretty interesting product to trade Bitcoin options, and those same factors where basis is correlated with the underlying, those will play out in that ETF product.
But we can explain to that person that that anybody can trade the CME options very easily in an existing brokerage account that has that offers futures options.
Yep, exactly. TradeStation, I know, is one that supports that stuff.
And I think Interactive Brokers too.
Oh yeah, I'm sure Interactive Brokers does as well. I think TD Ameritrade does not. They offer the underlying, but not the future options. But they do offer the BITO options.
That's fascinating. I hadn't really heard of that Veto platform.
Oh yeah, it's a BITO.
Great. Oh, BITO, okay.
It actually does a pretty decent amount of volume. It's about 25% of Deribit. So that's pretty good compared to the rest of the crypto options landscape. So that's something we're actually going to be adding to our platform here pretty soon. Really excited about BITO.
How is the bid-ask spread on the BITO versus the futures and futures options?
Actually haven't compared them side by side. Those future options are pretty new, so I would actually expect the future options to be wider than BITO. When I've looked at BITO, it's relatively tradable. It's close enough to trade. The CME future options, especially the full size ones, those are the last ones I've actually traded. Those are pretty wide.
Okay. Another question is, do you have any idea if there's any VIX type products on Bitcoin?
Not right now. So there's just this D-Vol index, which is the VIX index, but Deribit is going to be launching a future on it. So you'll have a VIX future or D-Vol future, which is a VIX-like product.
Okay. So when I look up like DVOL, I'm looking at an ETF when I'm looking it up on Yahoo. So where would I find that? The DVOL?
Yep, we have it on our website. So if you just, let me just drop that right here. But yeah, pretty much, I don't know that it's on Yahoo. It's maintained by Deribit, and we've connected to it and basically populate it.
Thank you.
Yeah, no problem. Cool. Well, if there's no more questions, thank you so much, John. I really appreciate it coming on and sharing sort of insights on the crypto options landscape.
Fantastic. Greg, we really, really appreciate it. We can continue here for a few minutes after Greg has to drop off, and he's got 89 million activities. So we certainly appreciate that. We'd rather have him, not spend too much time that's an inconvenience to him. So, but let's continue ourselves. Boy, that's really fantastic. And we wish you the very best of luck and with all of your ventures.
Thank you so much. Well, I really appreciate it and happy to come on. Thanks, everyone.
Okay, thanks. Bye for now.
Thanks,
See ya.
Greg.
Bye.
But let's continue a little bit. Does anyone have any questions or points that they want to make? Is anyone trading any options or even any Bitcoin for that matter? That can talk about just a little tiny bit.
I'd like to try trading some of the Bitcoin or the BITO spreads, but they seem a little too wide to me, and they don't have enough. They don't seem to have enough volume to be able to get out very easy.
And which ones are those again, John?
The BITO.
Oh, that he mentioned there.
Mhm.
Did he say that was based on Deribit?
He said it was, so it's based on a ETF, a futures contract,
Oh,
but it's an ETF.
oh, I see. Well, it definitely is a challenge, isn't it, to trade these instruments. I mean, there was a huge fuss over difficulty in trading Deribit because the U.S. regulators try to go after prevent people from trading Deribit and the other foreign exchanges. Well, actually, they're not. They're not touching the people who are doing the trading, because my interpretation is that is legal. But they do have the right to prevent those foreign exchanges from marketing to U.S. residents. Is that your understanding also, John?
I'm not sure on that one. I know you can buy them in the US, but I don't know anything about and I know sometimes on some of those ETFs, there's some like tax implications. So it's a real pain when you're doing your taxes.
Yeah, I'm wondering if that only applies to the underlying, if you trade the underlying, or whether it would also apply to derivatives.
What are those called? 1256 contracts?
Oh, well, 1256 contracts are taxed as 60-40, 60% short-term and 40% long-term. That's the standard tax treatment, which is extremely advantageous for most people. And that's why a lot of people will trade only futures or futures options. And from what you're saying, I think you're referring to that, and that's an advantageous tax treatment.
Okay.
I mean, people should think that they could avoid tax. That's not the point at all. I mean, if people don't pay the tax on the foreign trading and declare it properly, then they really would be in trouble. But I think if you can, get the foreign exchange to, to accept the trade, to accept you, a lot of people use VPNs, then I think it's okay, legally speaking.
I know there are some issues with the underlying Bitcoin. So I don't know if there's issues with the Bitcoin.
Well, the nice thing about the SEC regulates underlyings and ETFs, but the CFTC regulates futures. And so I'm thinking that sticking with derivatives will actually be, the only viable proposition. If you look at the margins that you're paying for any sort of underlying, and as you say, the illiquidity probably in the ETFs, and then some sort of futures, even if it's only the CME options, are going to be extremely advantageous from a leverage point of view. Ryan, do you have any thoughts?
No, not really. I think that was a really great point you just made, though. I thought I think Greg also did a fantastic job. That's quite the platform. I was a little overwhelmed by all the graphs, but I'd love to watch the video again and really dive into his software.
Yeah, I mean, he seems to have all the tools there that we should be using also for, for option trading on equity options, and we're not, largely speaking, not all of them anyway. I mean, all this basis and his business of identifying the aggressor. He mentions there are some platforms, and I think we need to look at them for equity options also. Anyone else have any thoughts or experience?
Hey, Don, this is Mark.
Hey, Mark.
It was very impressive. I was a bit overwhelmed with all this stuff. I don't really know a whole lot about crypto. So, in my mind, it's kind of a directional play, but it looks like you can do conventional option strategies in it. So it's all kind of new to me, though, and the tool is very interesting. I would love to dive deeper, like Ryan said. I want to watch the video again and maybe dig into some of the YouTube videos and try to understand this better. The guy is like light years ahead of me. So,
well, I mean, these are great instruments. I mean, we have things like calendar spreads, and at times we're selling calls and puts, but it seems to me we need to be able to get into things like he was mentioning, where they have identify who's paying the spread. I mean, that alone would tell you a lot.
Well, I love the idea of applying this to the SPX and conventional equities as well, if possible. I mean, I'm not even sure if you can plug in an index to this and get the same sort of information, but it's very interesting stuff.
I mean, I know you're looking at spreads and that kind of stuff when you do your own trading, so I think it is very applicable. He mentioned, gamma. What do you call it? Something gamma.
Spot gamma.
Yeah.
Yeah, I was mentioning about spot gamma. But hi, this is Rocco. I had a couple of comments about this. I mean, first of all, I found it very, very useful. So thank you so much for setting this up. It was an amazing presentation. I also found Greg was explaining so many concepts that I think I would probably need some kind of a wiki or something for because some of these graphs he was mentioning, I think some type of analytics that he may have come up with. I'm not really sure, or maybe not familiar with it. So either way, I think it would probably take a little bit to get used to all of those charts and kind of navigate through it. But the amount of information analytics that was there was pretty impressive. I would love to see the kind of analytics on equities, but I mean, he was showing the open interest and like who is buying the puts, who's buying the calls, and like that kind of information you only get it if you have access to the data on the chains and on the actual on the exchange. So I'm not sure how you would get that kind of information on the equities, at least at a reasonable price.
Yeah, I mean, that's true. Well, he meant you as you say, it's spot gamma, and I guess we need to have those people talk.
Yeah, they do a lot of analysis on basically they look at the gamma of the market, and they tell you whether the market is positive gamma or negative gamma, and how this affects the volatility. They have a newsletter, and I think they publish their documents every week. They have a new update with new document. It's a subscription fee model. They're kind of complicated sometimes to understand some of those topics, but they have really good content. I follow them for a little bit.
Yeah, I see. We should definitely get them and to talk if they will.
Yeah, and another aspect that he was talking about the basis. So And I'm not sure too sure if was you referring as the basis as the standard cash and carry trade where you just basically earn spread, and that was the basis on top of which he was evaluating other strategies, or was it about something different? That's something that I'm not sure I totally understood.
Well, I think he just, yeah, I mean, I think he just meant the premium of the futures over the spot.
Got it. So yeah, so that's the cash and carry. Okay.
And now he also calls that, yeah. Or, I mean, that's a starting point of it. Or was there more, there may be more subtlety to it. But I think futures traders talk about that a lot in general, like grains traders and that kind of stuff.
Yeah, because the spread between the future and the spot price is quite big on the Bitcoin. It's much higher than what you would normally get from on equities or indexes or whatever. So that's where we actually already get like quite a good interest in like a return just by doing that strategy, which is basically risk free, other than counterparty risk. You basically lock in your free money. Obviously, you're talking about 1% or something. It's not like a huge amount of money, but it's definitely more than what you would get if you were to do the same strategy on an index or something else.
So in that case, you would go, well, I guess you could spread one against the other.
Yeah, you buy the underlying, you buy the spot, and you short the future against it. And if the future is price high enough, because the two they have to converge by the time the future expires, then basically you locked in your profit.
And he mentioned that can be compounded by also the volatility. So
yes,
both at the same time gives you a double whammy. Yeah,
because the higher the volatility, the more the future spreads, right? I mean, you can have like a big jumps, and the fact that I think the fact is that it's not that efficient, so the price of the future does not react as fast, or I mean, not necessarily the price of the future, but the price of the two, they don't like kind of synchronize as fast as would normally happen in the normal markets, and that causes the spread to kind of widen even more sometimes. So you can actually get quite some juice in there.
Well, he was saying that I mean, we have the term efficiency. Efficient pricing would mean that there's nothing there to be gained.
Yeah.
And he's saying it's quite inefficient. In other words,
correct.
That there is something to be traded. And I mean, wherever we could find that, I mean that's great news.
I was wondering, has anyone here traded on Deribit before, or
on Deribit? Has anyone traded on Deribit? Or what's the other one? There's another one too that's widely used. There's a couple of them. I've been looking at the Google group. I'm sorry, at the Reddit group on crypto. And there's quite a few people on there who have. So you could look there.
Thanks.
Some of them are just using VPNs a lot. And they say that the foreign exchange doesn't really care. They just want a nominal adherence to they just want to not be able to, really the CFTC and the SEC have no business trying to regulate this trading, but they try, and they don't try to, I've never heard of a trader being penalized. They're only trying to get the exchanges to enter into their regulatory schemes, which they don't want to do. So I'm figuring I'll do that. I've done it before. I've traded abroad. I haven't traded Deribit. Are you tempted?
Yeah, I was curious. Yeah, definitely interested because of this inefficiency, right? I mean, I was looking at some of the prices on the options, and I mean the volatility is there. It's quite juicy, and obviously there are opportunities, but I haven't yet started on it. I just trade normal options. So, I mean, on the US market.
Well, I'm glad to hear there's people getting into this space. Let me know, Rico, or let us know if you have ideas for more talks. Next week, by the way, not next week, but in a few weeks, in 3 weeks, we'll be having a talk on machine learning and crypto.
Oh, awesome.
So that's by Mr. Chan. I think that's going to be interesting. Now, he's not trading derivatives. He's trading the straight future. He's doing non-expired perpetual futures on a whole bunch of, creating a basket of crypto instruments, presumably on Durham, or no, there's another one as well. I can't think what it is. And hopefully we can build on that. There seems to be lots of interest in it. Anything else you want to do, Ryan?
No, I think that's it. People were asking where the recording is going to be posted, and that'll actually be in our Raleigh Durham traders meetup channel. Do you have a link for that, Don?
I will get one if you want to talk for a minute about something else. I think if you just search, well, let me look here. Meetup.
I think I have it pulled up right here. Is it the Raleigh Durham Open
Yeah, that's it.
Options Trading Strategies group?
Yeah, it is.
Okay. Yeah, I think.
Yeah, we'll definitely have it there. I mean, I post them there as soon as we can. And for those Aeromir subscribers, it'll also be on Aeromir. We don't want to forget them. So it'll be on Aeromir for those who are with Aeromir. Yeah, exactly. And that, we'll do it as soon as Aeromir gives it to us, which is usually, which I think will be within the next day or two. Any final comments? Thank you, Ryan. That's great to have that on there. Did people get it? If you don't manage to copy it in time, it's just ask in another forum or search on Raleigh Durham traders. I think you'll find it. Okay, not hearing any other ideas. I think we'll just call it a day. Thank you very much for being with us.